market like Victoria, which was so driven before by government, but now you have education, you have the hospital expansions, you have real estate and construction. There's so many industries now that help prop up that community that you're not really going to be in a position of having one or two things falling.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow.
Man, seasoned vet. I love these conversations. It's so much easier.
Make it as painless as possible for you, I promise.
Thank you very much. All right. Well, Mr. Cory Wright, welcome to the podcast, my friend. Really excited to have you on the Flow show here today as a seasoned vet in the podcast space. Oh, but more importantly, an owner of William Wright Commercial. Just so excited to have you come on to talk a little bit about commercial real estate and what's going on in the marketplace these days. Just to frame the conversation, we actually, interestingly enough, and you and I were briefly chatting about this, we've been getting more and more inquiries in the past, I'd say 12 to 24 months about commercial real estate specifically. And it's almost like hidden behind, I don't want to say a paywall, but it's almost like it's hidden behind some magical wall where the people who know everything about it are mystical creatures. And you're one of those mystical creatures. So I'm really excited to have you come on and share with us a little bit about commercial real estate today.
Well, thanks so much for having us. And hopefully we can debunk that myth, because the information out there, there's a lot more information and a lot more people that are willing to share information than you'd probably think. So hopefully we can convert any of those people that are fear the commercial real estate realm.
Absolutely. And before I get into it, and there was already an intro, so most of the people listening to the intro would already know this, but you got an Unreal podcast yourself. Please give us a little bit of information about the podcast before we get into it so people can find you on there.
Yeah, so we started a podcast a couple of years ago called the Vancouver Commercial Real Estate Podcast, and people might probably know Matt and Adam's podcast for the Vancouver Real Estate Podcast on the residential side of it. We were very fortunate to kind of piggyback all their success for years. We kind of started on third base, it feels like. But that podcast has taken on a mind of its own. It's grown exponentially. And on there, we really wanted to take an educational approach to the commercial real estate realm, because there was other podcasts out there, and they're kind of at very high level information that someone like myself, who eats, breathes, and lives this every single day, I was finding it very hard to listen to it. So I'm like, if I don't really want to listen to it, then I can't imagine the average person that doesn't know about commercial real estate doesn't want to listen to it. So we kind of took an educational approach to it, trying to break down a lot of the myths, and had a tremendous amount of guests on to kind of talk about their contributions to the commercial real estate industry. We've had politicians, we've had CEOs, we've had top agents in the world from all over North America join us. So we've been very fortunate to kind of share that information out there, and through that, I think there's a lot of maybe first-time commercial real estate investors or first-time commercial real estate tenants where they were maybe scared to enter a lease. They didn't really know what one was. So we've tried to break down as much of that at an educational level as possible, and it's worked out tremendous. So we're very appreciative to all the listeners that join us there.
Awesome. And I'm hoping, Cory, that after this today, with the listener feedback, we'll have you come on again in the future to talk a little bit more about what's going on as we work our way throughout the course of the year. Because in our conversations, I've learned so much in just a short period of time. So, Cory, really, I mean, there's no point in having any real conversation about a person until you know who they are. And I'm going to ask you some other questions later on, which the guests or the listeners are going to love and want to listen to. But let's just briefly touch on this commercial role. I mean, you shared with me a little bit about it yesterday, but it's not important to share it with me. I mean, give me the lowdown, give me the dirty. Not everybody that gets into commercial real estate intended on doing it, but some do. How did it happen for you?
Yeah, so I was in the hospitality industry for years, and through that business, or through that industry, we were tenants, we were landlords, we were buying and selling business. So we worked with commercial brokers on all facets of that for the better part of a decade. And the plan was always to eventually go into the commercial brokerage industry, because in the hospitality industry, you make a lot of money, you lose probably more than you make, and you've got probably a timeline in which you have the energy to do that industry. So coming out of that and working on all facets of the commercial transaction side, I really felt there was an opportunity that we could sort of open up maybe a little bit more of a niche market type of thing, for lack of better words, in the commercial real estate side of it. A biggest part of it is so many of the commercial brokerages prior to had a major focus on large scale landlords, developers, pension funds, REITs, institutions, when really probably 99% of the commercial real estate is owned by people like me and you. And when we went into that, we thought that hopefully there's an opportunity for us that we could sort of build on where we thought there was gaps in the system. And I started with a residential brokerage on purpose because I wanted to really test out to sort of see if how my thoughts as a client over the years, if I, this is where I thought there was maybe a problem, and if I could sort of hopefully fill that gap in for a lot of people. And then fast forward 18 months, 18, 19, 20 months, I guess it was. After that, we opened William Wright Commercial, and we had, 200 square feet. There's myself and one other first person we ever hired who's still with us today. And we had one office was an ex-server room. So it was freezing cold all day, but the thermostat happened to be in like the other office that we couldn't access. And then my office had no AC, but had a skylight for extra heat in the summertime. We had no windows. I think it was the only landlord at the time that wouldn't check my credit score, probably. So we're like, okay, well, we're going to give this one a shot. And the goal was always to kind of break it down and sort of make it accessible, hopefully for more people, and educate them along the way, but also have boots on the ground in various markets. Like residential, every market and submarket, you can find a RE/MAX office as an example, but commercial real estate, that didn't really exist the same. You'd have large firms, maybe more in hub cities like Vancouver or Calgary, and they would try to do business throughout the whole province. So our goal was we were going to have boots on the ground in all these markets. And instead of having 100 people in Vancouver, we're going to have 50 people throughout 7 offices in BC, so we can capture every major market. COVID came on us unexpectedly and put a big onus on a lot of these secondary and tertiary markets where we either had footprints in already or were getting to put footprints in, that it just really kind of shot us out the other side of COVID like that, because we already had a presence in these markets. And now you're finding when people want to invest in commercial real estate, especially in the current debt market that we're in right now with very high interest, it's really hard to make numbers work maybe in the greater Vancouver area. But if I can go to a market like in Nanaimo or a Kelowna or Victoria or Kamloops, a secondary market, that I get a higher cap rate on it, helps me service debt. So, we were operating in those markets already, and now we've got the 7 offices and a tremendous, incredible team of professionals across the province that make this happen every single day.
Well, first of all, thank you. There was a lot to take away from everything that you said right there. I think a few things really stand out for me, Cory, that we're going to key on in the beginning of this conversation. And the first one being the fact that you said explicitly, obviously, number one, you started in the residential space to get an idea as to what was happening or how they did things, and then took that over to the commercial space. And the second that I picked up really importantly was the fact that you went into micro communities as opposed to being so macro level minded. So you weren't just in Vancouver for the province. You went into a variety of communities, which you said the Okanagan, the island. Could you maybe name a few of the others that you mentioned that you guys were in?
So we have offices, we have an office in Vancouver that obviously services the greater Vancouver area, and that's where I'm joining you from today. But we also have an office in the New West market that services the Tri-Cities in the West, and then we have a Fraser Valley office that services all the way out to Chilliwack, as well as we have Kelowna, Kamloops, Central Island, which is in the greater Nanaimo area, and Victoria, and even the Lower Mainland. With the demographics and the population shifts and all that stuff, we really wanted to make sure we had people out in these markets, not necessarily in Vancouver, trying to parachute throughout the province. And I think that's given us a tremendous competitive advantage in a lot of things. The one thing that I think a lot of people may be very surprised at when you go to markets like a Kelowna or a Victoria now is there's not a huge delta really in price point or lease rates in some areas. So having the professionals on the ground, dealing in the local communities, getting right into the fabric of those communities really gives us a competitive advantage when helping clients throughout the province, because a lot of groups that own in Nanaimo, they also own in Kelowna now. So
interesting.
It helps out that way.
So you said kind of near the beginning that a lot of what you actually focused on, or at least I think I heard that you say this, is that you weren't so much focusing on the super high level, business owner that's owning, 50 different units or buildings. You're focused more on the single potential, or at least in the beginning, I should say, the single potential investor looking for some type of commercial asset, whether that be a business owner or someone looking to, own a portion of a strip mall or something of that nature. Right. We're going to break this down from an entry level perspective, but we're going to, obviously you give great answers, so I'm sure we'll go a little bit more in depth here. Initially speaking, a lot of people avoid commercial real estate as any kind of investment, as we talked about right off the bat, because they believe it's inaccessible. They don't believe they can either get financing on it, or they don't believe that it's more complicated or it's more expensive. These are the things that we hear on a regular basis. So perhaps, Cory, we could break it down briefly and just talk a little bit about where and how, or where and why commercial there is an opportunity in this space for people who are transitioning from perhaps owning a couple of residential pieces of real estate, but they want to maybe add commercial to their portfolio, not get rid of residential, but maybe they want to add to it. Where does someone even start in that conversation, or at least how do you begin those conversations?
So the number one starting point is the easiest way to probably start is to connect with a commercial broker, just to kind of learn more about what potentially you may actually be buying into. And the two biggest things I think that resonate with a lot of investors is if I have a house or a condo, the tenant's paying me $2,000 a month. It's a flat number. And out of that, I have to pay all of my property taxes, my insurances, strata fees. So that $2,000 can dwindle down quite a bit. On top of that, the leasing of that unit is governed by the government through an RTA, Residential Tenancy Act agreement, where it really limits the potential increases year over year until a tenant moves out with it. So I've got a gross rent deal scenario that I'm dealing with. And I'm also very restricted in regards to potentially what my rent could increase on an annual basis. My costs, property taxes, strata fees, insurances, they're probably increasing at a greater rate than what that rent's increasing. So that's one challenging part of it. Versus on the commercial side, you have, in most cases, you have a triple net lease where you have a base rent component, $50 per foot, let's say, that represents market value for the space. And then I have triple net costs that represent my property taxes, my insurance, pretty much my operating costs without my debt that get passed on to the tenant year over year. So as those costs continue to unfortunately go up a little bit every single year, those costs are passed on to my tenant, thus protecting my base rent. So that's the money I use to debt service versus on a gross rent deal that you traditionally find in residential is as my costs as a landlord increase, the amount of money I have left to actually service my debt probably decreases year over year. And because I'm governed by what I can raise my rent to every year, I may not be able to keep up with that. And then the second part in commercial that tends to resonate quite a bit that you'll probably be able to talk more about than I can is the lending ability on commercial. If I buy a house, you're calling me and you want my T4 and you want all my information versus when I'm buying a commercial real estate property, although I still have to supply that to you, you're also asking me who the tenant is. How much are they paying? So it gives the ability to probably maybe grow a portfolio at a little bit faster of a pace because there's a lot of onus put on the tenancies of those properties and not so much what Cory makes on an annual basis.
Right. And so just to kind of break that down, first and foremost, what you said right off the bat is that if your costs increase subject to your lease agreement and what you agree to with your tenant, their costs increase, not necessarily yours. So it doesn't eat into
Correct.
all of your profits, maybe some, but not all of them. And the second is, as you mentioned, there's no residential tenancy agreement with commercial. Does anyone govern commercial real estate leases, or is it kind of like the Wild West?
So in commercial real estate, you'll hear things like landlord standard form lease. That simply just refers to the lease that the landlord chooses to use for their property. There's not, in quotations, a standard lease like you find in the residential side of it. So every landlord has the ability to kind of articulate their concerns through their lease with it. And hopefully a lawyer's doing it for the landlord. They're not taking on that role themselves. The other thing that kind of helps out a little bit, unfortunately, is part of the business, is when your tenant doesn't pay, the remedies, timelines, and all that stuff to unfortunately move them out if they're not paying is a lot quicker than in the residential side where you find the RTA agreements, which may be months and months and months and months before that actually might get resolved. In commercial, it can happen quite quickly, and that's all articulated in the landlord standard form lease.
Okay, it's a great question or great answer to that, and it kind of leading me forward here. So we're talking a little bit about residential as it relates to commercial directly, and obviously how lease agreements are set up and how they work or don't work. But again, a lot of people, at least up until today, have chosen to make residential real estate a big part of their rental portfolio, and there's a lot of good reasons why they might want to continue to do that. In your experience so far, when people are moving into that commercial space, what are some of the things that typically, stop them from being able to take that next step? And why, in your mind, do you hear people say, you know what, I'm going to stick with residential, at least based on your understanding?
Yeah, everyone's scared of the unknown. And, all of us, we have to live somewhere. So we all either rent a place or we own a place. And that creates a level of comfort. So when we're buying an investment property, we can relate to maybe a condo or a house a lot easier than we can relate to maybe a tilt-up industrial strata lot. that we don't know anything about. So there is a very gradual transition for a lot of people, and a lot of people make that entry point in a single strata lot where they're kind of learning a little bit how the landlord kind of side of the business works. We, hold people's hand from start to finish through the actual transaction, make sure they get off on the right foot. What you tend to find that happens more times than not is once they've actually dipped their toe into the commercial side and they see the benefit of a triple net lease, they see the benefit of like market conditions moving up, and they can kind of, when the leases come for renewal, there's not really a governance on that lease, that there's a lot more kind of protection. And then on top of it, the ability potentially to either refinance some capital out or equity gain just based on, lease rates and market conditions might be a little more favorable than residential. We tend to find that clients may sell off one or two of their other condos and maybe expand a little bit more on the commercial side because there's a level of comfort there now they've established that maybe before they didn't have. And we're happy to walk people through that full process, start to finish.
Right. And so leading into that process, one of the things that I experienced in buying and owning commercial real estate as well is, and I think this is another reason why people are nervous or concerned about getting into commercial as part of investment, is time. Time is very different in commercial transactions from a lending perspective, possibly sourcing it altogether, the lengths of the leases. So that one factor, time is money, obviously, is one of the reasons that I've seen people actually say, you know what, I'm going to stick with this residential play, whether it be a buy, flip, refinance, the same kind of strategy versus real estate. Hey, because I can get this done in, 3 months instead of, 1 or 2 or 3 years. So in your mind, has that been a big part of why people, have elected to stay away from commercial, or what does that do as far as the impact on what people do?
It definitely can impact the decision making, the process. Mainly, I think a lot of it is because it's very unknown to them and they're kind of going down that road, and they're used to maybe getting pre-approved for a house. They go look at the house, they have a 7-day subject period maybe, and then they're removing the condition, they close a month or two later. Versus in commercial, there's so many different more facets that actually go into the transaction, from the lease and the expenses and triple net costs and all of that stuff, that your subject period may look closer to like a 30 or like a 45-day timeline versus a 7-day timeline. And a lot of that is because you may have to commission appraisal reports, and those take longer in commercial than they do in residential. And in residential, it's a lot easier for an appraiser to say, hey, the condo next door sold at $550,000. This condo is identical, a little bit nicer, so let's go like $565. In commercial, you might have two identical units hypothetically side by side. And if we're talking about a market cap rate of, let's say, 5, which we can dive into what a cap rate is, but this tenant pays $20 a foot and this tenant pays $40 a foot, hypothetically, one will sell for double the price. So it's not as easy to sort of just throw a blanket statement out there that these 3 condos sold for this, so that's what this is worth. There's so many different facets that go into the actual appraisal process of the commercial real estate standpoint that makes it maybe a little bit longer. But traditionally, you might look at, if I'm an investor and I'm buying a strata lot, an industrial strata lot, which is probably one of the easier ones to kind of acquire right now, I might look at a 30 or 45-day subject period, and then I may look at a closing of 30 or 45 days after that. So you're looking anywhere in that 60 to 90-day realm to kind of make it all come together. But the benefit is, if you get a tenant in there that may have a 5 or a 6 or maybe a 10-year lease, is you can kind of pencil that income for the foreseeable future and not have to worry maybe every year potentially you got to go re-rent it out and stuff like that on the residential side.
Okay, well, you started the conversation already with regards to talking briefly about cap rates. And now I obviously understand how that can impact the ability to purchase or buy real estate. And maybe we'll come back to the lending side later this call or even in a future call. But for conversational purpose, do you mind breaking down how you explain cap rate and its importance to a new commercial buyer or investor?
So you have what they call a cap rate or a capitalization rate, which is pretty much dictated by, you'll hear terms like NOI or net operating income. That is the money that the property has after expenses, before debt, left over to pay my debt. So when we talk about our base rent and our triple net cost, the triple net primarily covers or should cover most of my expenses, if not all of my expenses. So if I had a 1,000 square foot unit and the tenant was paying me $20 per foot per annum, I would have $20,000 in NOI or net operating income. And a cap rate is a reflection of the NOI versus the purchase price. So if I bought a property for $1 million and that property had a 5 cap rate attached to it, that would represent $50,000 in NOI. And what happens is the lower the cap rate is, the higher the price goes, because that same property that may have $50,000 in NOI that sells for $1 million or a 5 cap rate, it might sell at $2 million with the same $50,000 in income, because the income hasn't changed, but now the cap rate is 2.5, not 5. So when you're looking for investment properties, what a lot of investors will look for is potentially a higher cap rate, because I have more income that I can then use that money to service my debt and pay my mortgage.
And so that is one of the most unique things about the commercial real estate, just kind of breaking off for a quick second here, when it relates to residential real estate. I mean, if you have, like you mentioned earlier, if you have two detached homes side by side and one's acquiring $5,000 of rent because they've already got agreements in place, but one has $3,000, that $3,000 one isn't going to sell for substantially less, because it's typically based on the market value of the home at that time versus what that rent will do. Although that could slightly impact the mortgage qualifications, typically not even that. So you're more comparing, land use versus land use and the actual structure there versus commercial real estate, which is, as you mentioned, and this is where I think people get most confused about it, Cory, at least when my conversations, is it's 100% subject to what you're receiving on that property. And now, future conversation, just to bring people, you gotta come back to a future episode with Cory on this one. But this is why we hear and we see in the commercial world, I should say, more people looking for properties that they can buy and even acquire with partners, put work into the building, increase the potential cap rate, and refinance or buy another one. Do you mind giving just a brief explanation as to how that most commonly works in the commercial space?
100%. So typically it's referred to like as a value add property, which means there's opportunity to extract additional equity in the property out. So one thing we talk about a lot on our podcast is these secondary and tertiary markets. So making a comparison, say, to downtown Vancouver, if we go into Yaletown, and maybe you go back to 2005, 2006, pre-SkyTrain, you might have found lease rates in and around the SkyTrain station, $35 a foot, $40 a foot. And then you fast forward to 2012, 2013, those same units, because of the SkyTrain and additional density and populations moved in, they were renting for $80 or $90 a foot. And now that same unit might re-rent 5 years later at $95 a foot. So the point I'm trying to make here is there's that one opportunity in some markets where you have that tremendous lift that takes place in the rents, and that is where you can extract future value. So where we find a lot of that happens now is in secondary markets, say like Kelowna, for example, and we'll just use an example where you might have a building that could be locally owned and operated, which there's nothing wrong with that, but maybe there are people that they've paid the mortgage off, maybe they have relationships with the tenants, and they're charging the tenant $8 a foot base rent. And then what happens is market booms, population comes in, and they haven't raised the rent because they have a personal relationship with the tenant, and then they go sell the building. So if I buy a building with a 5 cap rate on an $8 a foot base rent, I buy it, I renew the tenants, or I relet the property at hypothetically $16 a foot. That market that I'm operating in is still servicing a 5 cap rate, but based on that example, I've now doubled the value of that property, because that property value is derived by the net operating income that it services. So in that $8 a foot, now it's $16 a foot. I bought it on a 5 cap rate. It's still worth a 5 cap rate in the investment world in that particular scenario, but I've doubled the value of the building, hypothetically from $2 million to $4 million. I now go get a new appraisal. I call you up. I give you my appraisal for double the value. And because I have more income to service a greater amount of debt, there's the opportunity potentially to extract some of that initial capital out of it, de-risking the asset, and then still owning it, and then taking that capital and redeploying it, hopefully in a similar type strategy in the same marketplace.
So thank you, first of all, for explaining. That's a fantastic explanation and example. And to kind of bridge the gap, because a lot of our listeners might be more focused on the residential space, we do hear a lot of people then moving recently in the last couple of years more into the multifamily space, especially with the CMHC programs that are currently available. And of course, you just explained something very similar in the commercial space, so business space, if you will. My question comes back to the initial question we talked about, which is always something that people ask, and that comes down to time. you just shared a situation, and I know it's subjective to
Yeah.
general, variety of things, but could you articulate, in a few circumstances or just what you've seen in the last perhaps couple of years of how long that process could take, or maybe an example of one or two that you've seen recently, just so the listeners could get some context?
So hopefully before you buy the asset during your due diligence period, the agent you've engaged, they'll be able to provide you with some market data to show you what the market lease rates are versus potentially what the tenants are currently paying. So when you're looking at that, things that you're looking for is maybe shorter term leases in place or leases coming to the end of their expiry allows you to extract that value quicker versus if a tenant's there at $8 a foot for 5 years, I won't have the opportunity to get that additional revenue till 5 years down the road when I can renew them potentially at $16 a foot. So there is time that goes into that process. But if you engage a good commercial broker, they can do the lease renewals for you. They can handle that whole process, as well as there's companies like one company we own is William Wright Property Management, where we manage commercial properties on behalf of clients. That whole process can be done for you if you engage the right people around you and a strategy going into that acquisition. I necessarily wouldn't recommend an investor, maybe who doesn't have a lot of commercial experience, to buy a building in Kelowna and try to deploy this strategy. It's not that it can't work, but we're making it sound as easy as we can. But there is things that go into it, like market comparisons and all this stuff when you're doing the renewal aspect of it, that engaging a good broker from the start with this strategy, they can help you execute on that. From a timeline perspective, I know I'm answering the question in a big roundabout way, but
That's
from a
all good.
timeline perspective, it's all derived by the lease terms that are in place
Okay.
when you buy the property.
Okay. Yeah, that makes sense. Well, something that you've brought up a number of times, Cory, and because you've heard this and listened to this for the better part of 13 years in the commercial space, and this is a question that's come from both the residential real estate agents, but also clients have heard this, is what people have a really hard time grasping is what the heck is with so much, we'll use the technical term, exclusivity. I mean, we talked about this briefly earlier. And to explain that to the audience who might not know what that is or are not in the real estate industry, that's essentially why aren't these on like a general list, all these different properties that anyone could access at any time, or at least any real estate agent could access any time? It seems like obviously there is a commercial version of the MLS, so to speak, but there's just so many properties that sell that no one knows about. Why would they want to do that? Why would sellers want to do that?
So I'll start by saying, if you do find a property on the MLS, it doesn't necessarily mean it's a bad property, because people in the industry sometimes have a stigma like, oh, it's on the MLS, it's been picked over, it's just the garbage that ends up there. So there's still great properties on the MLS. So don't discount if you find it. But why things are done so much exclusivity or even very quietly off market, we refer it to, is a lot of landlords don't necessarily want other tenants in their property knowing what other tenants are paying. So when we're putting lease product out there, it'll say like contact listing agent for prices. If something goes onto the MLS system, you have to disclose those numbers. And a lot of landlords, if you had an office building maybe with 30 different tenants in it, you may not want other tenants in the property knowing what other tenants are paying. And to go through the MLS system, that all has to be disclosed. Same on the sales side of things. A lot of people maybe they're an owner occupier of their own building and they have staff, so they don't want their staff to know the building's for sale. Maybe I don't want my tenants in the building to know it's for sale. So a lot of times too, through the broker community, you'll have brokers that deal in certain asset classes or certain areas that a lot of people don't realize how small the commercial real estate world is, where if you do office buildings in Kelowna, you probably know all 6 owners. And if somebody wants to sell one, they may not want the other owners knowing that they're selling it. So they might say, I would consider selling. Here's my expectation. You can run around with the property quietly, but I don't want anyone to know what's going on. And then that's where the MLS system, unfortunately, does put that out there. But like I do say, is because you see it on the MLS, it's not bad. It just means for whatever reason, that was part of the strategy to list it there. Maybe the client wanted it there. Maybe the broker felt that was best for exposure. But probably 90-ish%, give or take, of what probably transacts is probably off market.
Makes sense. Okay. Well, great answer. I can't really argue with that, Cory. Thank you for that. I think, again, in an effort to try and focus down on people who are mostly kind of entering this space for the first time, now you tell me if I'm wrong here, but I would probably imagine that most people who are entering, commercial are somewhere in that $1 to $3 million range is what they're looking. Okay.
Yeah. Totally.
Based on your understanding of 2024 and kind of looking forward, I don't make you project too much here. Where in, because you're in BC mostly here, but I'm sure you have your boots on the ground. You understand different parts of the market and in different provinces. If you had that $1 to $3 million budget, what are the different types of communities or cities across the country that you would suggest people start looking at today?
So there's two arguments to it. Some people like something local where they can drive by it every day. So if that's the type of person that you are and that's what you prefer and there's a safety net feeling there and you live in Coquitlam, let's go find something in Port Coquitlam. If you're looking at more from a pure numbers standpoint, I would probably focus more on some of the secondary markets like a Nanaimo or even a Kelowna or even a Vernon for that matter. Things that we look for, and the criteria really doesn't change. Things that we look for is what is the asset class that we're looking in and what does the vacancy of that asset class look like first and foremost. If I were to go and say Edmonton, where maybe they might have a much higher vacancy rate in some asset classes, I can't necessarily go to my tenant who's paying 12 and tell him you need to pay me 20 because he's just going to pack up and go to the unit next door and pay $12 a foot because it's been vacant for quite some time. So knowing the vacancy rate of the asset class that you're looking in is super, super important. You never want to feel what they call pay for your own risk in the deal. And then on top of that, you'd also want to know the lease rates of the asset class that you're buying in. And when you look at some of these secondary markets, because now they have a lot more attention on them, both locally, nationally, and internationally, both from an investment standpoint, but also lenders are much more keen now on a Nanaimo than maybe they were 5, 6, 7 years ago, that you do get the opportunity to potentially get an increase on your rents, probably at a faster pace. Because like I said earlier in the show, is you'd be really surprised to find that the lease rates in certain asset classes don't really differ a whole lot from what you might find over here. If you looked into the industrial asset class in the Fraser Valley region, you might pay $18 to $21 a foot, and you'll go to Kelowna and you'll probably pay $16 to $20. So there's an opportunity there where you might be able to find some of these older leases in place that gives you the opportunity to get a relatively good lift on the property in a shorter period of time. But as population kind of grows and comes in, there's the opportunity there that those lease rates will grow because the reality when you look in downtown Nanaimo as an example, there's probably, I don't know, say 6 office buildings today. And the population there is probably 105,000 and growing. So let's fast forward 10 years. Now the population that's growing above the national average is probably 130,000, maybe 140,000. Well, guess what? There's probably 6 office buildings still in downtown Nanaimo because the numbers don't pencil the same to buy land and then build another office building. When everything's been pushed towards housing now, commercial typically lags the housing boom because developers buy land, they build houses. These people now they need to live somewhere, they need to go work somewhere, they need to buy their coffee from somewhere, they need to go to the dentist somewhere. Commercial kind of lags. So you kind of want to look for indicators on trends to find out if those markets will kind of hit a lot of that stuff from population growth. But the other big thing that a lot of people miss, in my opinion, is looking at the industries that are supporting that local community. If we look at what happened, unfortunately, in Calgary and Alberta, when the oil and gas sector fell out, is like the market fell out. And San Francisco kind of experienced a lot of that with the tech industry. So if you go into a marketplace that's propped up really on 1 or 2 different industries, you get to be very cautious that those industries could tilt in the wrong way and have dramatic impact on your investment. Versus if you look at it like a market like Victoria, which was so driven before by government and still is led by government, but now you have education, you have the hospital expansions, you have real estate and construction. There's so many industries now that help prop up that community that you're not really going to be in a position of having 1 or 2 things falling off. So I think to answer your question, I would definitely look in some of these secondary markets where I have above average population growth, various sectors that actually drive that community and those industries there. But more importantly, that if I can get a better cap rate in these markets to help service my debt, I'll take that all day long, potentially, versus maybe what I'm finding in Greater Vancouver right now.
Right. Oh my gosh, man, that was a lot. So thank you. I feel like you rehearsed that, but you probably said that every day for the past 6 weeks. So
You ask one question, you get six answers.
We're going
It's
here
kind of
and there.
value
All right, I'm going to put you in
proposition.
the spot right now. So you gave me all the reasons to look at, from what I heard, took away, of course. You gave me all the reasons to look at secondary markets. So I'm giving you the cash today, and I'm saying, Cory, you've got $1 to $3 million of my money today. What are your top three markets? Of course, it sounds like BC is where you're most familiar, which is completely fine. What are your top three markets today for someone with that type of comfort level from a budgetary perspective, assuming they don't have to be near their property? Where are you looking?
First one I'd probably go to is Nanaimo. And why we like Nanaimo so much is because you are getting a good migration of people from the greater Victoria area moving up. You're having a tremendous amount more people move into the greater Nanaimo area, and you have a lot more industry now in the Nanaimo area. It is still Nanaimo, and I don't mean that in a negative way, is things aren't going to lease as fast in Nanaimo as they do downtown Vancouver. So you can have those same expectations. But when you can get into a secondary market, primarily I would say right now retail is a great opportunity in that marketplace. You might have a potentially better run of the investment over a shorter period of time of what you'd find here. And one reason why we like retail so much is retail's coming off the back of COVID. And there was a lot of lease deals that were probably done during COVID that were very favorable to tenants, that now demand has sort of caught back up to that asset class, that you might be in a position to get a greater turn or a higher lease rate moving forward. You also have to be cognizant of what retail is. A lot of people think retail is dead, but retail is sushi restaurants and Starbucks and barber shops and dental offices, all these things that we still have to actually go frequent, or we can order to our house in some circumstances, but they still have to get picked up from somewhere. So I would say Nanaimo would be the top of the list. Another market that we really like is the Greater Kelowna area. And we say Greater Kelowna area, including Vernon and Lake Country and West Kelowna. They have a tremendous amount of population moving in. They've got education with the UBCO expansion, and they've got so many industries that are driving that market right now. The one thing I will caution with a market maybe like Kelowna is we don't know how the short-term rental restrictions will impact.
You took the words out of my mouth. Go.
Because you look at it like the tourism market, right? And we'll make a blanket statement here. If there's 1,000 hotel rooms in Kelowna that are already $500, $600, $700 a night in the summertime because of all the great amenities Kelowna has to offer, there might be 2,000 or 3,000 Airbnbs. Well, those Airbnbs potentially become longer term rentals, and I understand the motivation behind it. Now I don't hypothetically have 4,000 hotel rooms booked. I have 1,000 hotel rooms booked. So the question becomes, is there 3,000 potential tenants in that scenario to backfill those? Or is there 1,500 and then there's a little bit of an economy lapse just because I don't have those 4,000 people spending money on a daily basis. So, I mean, that's yet to be determined, but I do think when you look at the population growth of that market and just the cost of that market, maybe versus what you see down here, I think there's still going to be a good migration that's going to happen in there. And then lastly, and this is a market I caution everyone, I don't have as much experience in, but it's all the rage right now, would be like a Calgary. And Calgary is very much like a roller coaster ride. They've probably done a really, really good job trying to backfill a lot of the office vacancy that existed from the oil and gas sector with a conversion program. The question yet to be seen is, do enough buildings convert and do enough people want to live downtown Calgary to make that happen? But they have been doing a good job for the most part. Vacancy rates, believe it or not, seem like they're coming off. I don't necessarily know if I'd buy an office building in downtown Calgary, but if I could find a really good opportunity in the multifamily sector or maybe the industrial sector over there, those would probably be really good investments, because you are seeing a big migration of people going in there. And we also see on the commercial tenant side of things, where unless a business has to necessarily be in BC or the Lower Mainland, they can go over to the Rockies for a fraction of the price and create jobs and run their business very efficiently. And we're seeing the Amazons of the world and all these companies that are now increasing footprints in the Alberta market versus BC, because you can buy land at some cases 1/10 the price, and your lease rates are relatively similar, all things compared, maybe 10, 12, 14 versus 18, 20, but I'm paying 1/10 for the land. That's going to, my net numbers are going to look a lot different over there than they are over here. So I think Calgary would be a great opportunity. I don't have as much experience in the Calgary market per se, but we've been following it intensely for 6 years. And we do plan to have an office over there in the near future that we can hope capitalize on the great Alberta market.
A lot to take away there. So Nanaimo being your number one focus right now, Kelowna subject to what happens with the upcoming. And thank you for explaining the short-term thing, because I feel the same way. And when people are talking about that market right now, it's so hard to get a grasp on what the outcome could be, given the fact that it's been 3 to 4 years now of growth in that sector, and it's also followed the same trajectory of people moving outside of other cities and moving up to the Okanagan. Does that push people back to the cities? Where does that leave people? And then obviously that'll create some level of potential vacancies in the commercial. So really, really interesting feedback, Cory. I mean, I've got about 50 questions that I'm not going to get to today, so we're gonna have you come back on, and we're gonna direct people over your pod if they want to hear a little bit more, man. But I'm actually genuinely curious a little bit on your side of things. So one of the big things that I like to understand from people from a personal perspective is just really about their feelings and thoughts towards money. Now, obviously, you got into commercial real estate out of, I'm sure, a variety of purposes and goals. When you start a company, it's not all about money, but someone taught you along the way the value of it and how to multiply. One thing I've learned is that people who have success, especially when it comes to commercial real estate investments, don't have the same level of attachment perhaps as other people. Where did you start to understand or grasp the concept of investing and creating wealth through this? And how did you learn how to basically let go?
Yeah, well, I think in commercial, it's a lot more of a numbers game versus an emotional game when it comes to it. And I think the biggest thing from an investing standpoint is this is definitely not a biased opinion. I like to physically touch my assets with regards to what we own with regards to commercial buildings and stuff like that. I know the marketplace really well, so I'm comfortable investing in it. And also the ability to potentially create these value add opportunities where I can turn the capital at a faster pace. I can kind of build generational wealth for the family through that area. I was always, one thing that always concerned me with investing, let's say into stocks, is if Elon Musk has too much to drink and he puts something out on Twitter and that impacts my investment in his company by 20 or 30%, to me never sat right with me. So I like the tangible asset that we can physically buy in commercial real estate. And I think when you look at just real estate as a whole, over the past kind of 20 or 30 years in Vancouver, we've had a pretty great run that's probably outperformed a lot of other stock markets and all that stuff over the time period, that not as boom or bust type of thing. I think a lot of people, when we invest in commercial real estate, we're looking at it from a traditional model that we're going to buy it here, tenant will help pay down the mortgage, we're going to get equity in that property by a value add scenario, but then I can still own the asset long term and we live it every day. Like, you can go to Victoria on vacation and be like, wow, it's really busy here, right? You can really grasp that commonality that comes with it. So from an investing standpoint, that was always something that was really, really big to me, and always retaining the asset the best we can. We've definitely sold properties along the way. It's not that we haven't, but when it comes time, you look at the numbers and you may say, hey, for me to get this number today might take me this many years of rent to get there. And being a landlord isn't always as glorious as you think it is, right? Like your roof falls in one day, you've got a big problem you got to deal with that we've had to let go when the numbers made sense. And that money kind of just, comes back, and then we just hopefully find the next asset and just redeploy it and keep the train.
Hey man, that can happen on your house too. I had a branch fall on my roof a few weeks ago and I got a hole in it. So look at that. The joys of living in Brookswood. In any case, Cory, unreal answers, man. Really interesting feedback here from a variety of perspectives. And as you gave me 6 answers to every question, I have less questions for you without going on another hour-long tangent. So we're gonna hold off on that conversation for the next one. But the listeners, so you don't leave yet, really, really, really important. As I mentioned before, go and follow the podcast that Cory's got. We'll link it in the show notes, and check out William Wright's his company. And Cory's got a great team, plus agents, lots of people that can help you all over the place. So certainly reach out to him if you have questions about commercial investing. And if you enjoyed the podcast, make sure to leave us that rating and let us know so we can have Cory come back. We got to convince people to bring him back here. So appreciate your time. There we go.
Tons of fun.
Thanks for making time for me, my friend. Yes. It's been awesome. Appreciate you. We'll see you on the next one.
Thanks so much for having me.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget, our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.